Let's play Complete the Word. We know it's a bad word. We know it starts with F. We know it has 4 letters. And we know this course is rated PG. So that must mean the word is fees. Yep, fees. Those nasty buggers that strip away your hard-earned money. The bad news is they're inevitable. But the good news is you will learn the many forms they take and how to reduce them. Let's get started. Transaction fees. Transaction fees are usually flat fees for buying or selling an investment. They tend not to be that much. They could be $10 to $50 typically. For example, if you want to buy 100, or 10,000 shares of Disney, you'd have this flat fee. Commissions. Those are the fees you pay your broker or advisor. They are usually a certain percent of the total transaction. The bigger your buy or sell order, the bigger the commission. Think about selling your house. If you sell for $100,000, the standard 5% commission is $5,000. If you sell your house for $200,000, the same standard 5% commission is now $10,000. The third type of fee are loads. Okay, so how to explain them? Let me think. Okay, I've got it. They suck. I don't even need to tell you what they are. All you need to know is they suck. If something sucks, it's probably a wise idea to avoid it. So pop quiz. Should you buy an investment with a load? No! Fine. All right, I'll tell you what they are. A load is like a commission. If you want to buy an investment with a load, you have to pay a certain percentage for the right and the privilege to invest in the investment. Oh, how sweet and kind of them. For example, if the load is 5% and you invest $100,000, only $95,000 is going into the investment, and the other $5,000 is going into someone's pocket. How not so sweet and kind of them. So check this out. So what this represents is a mountain. Our goal is to make as much money as we possibly can. Imagine climbing this mountain. You have this person who has a heavy load. Get it? A heavy load that they have to drag up this very steep mountain. This other person has a very light load. They've got a little backpack. They can go up the mountain of money much quicker. You want something with no load, not a heavy load. But that's not all. If you order now, you'll get screwed even further. Investors noticed these loads and they didn't seem to like them. So instead of getting rid of the loads, that would be silly, the investment folks said, no problem, we understand. You don't have to pay us a load when you buy our investment. Aren't we nice? Oh, but by the way, when you sell the fund, there's going to be a load. If this program wasn't PG, I'd say a series of F words right about now. The next type of fee is an expense ratio. When you invest in an individual stock or bond, you pay the transaction fee or maybe a commission. But then that's it. There is no ongoing management. You own the stock and that's that. But when you buy a mutual fund or ETF, for example, the idea is that you're buying a basket of investments and that this basket of investments takes expertise to manage throughout the year. You have people, investment managers, who are buying and selling investments within the actual mutual fund or ETF. This is especially true for active managers. But even with a passive index fund, there are still some trades that occur and some expenses. I mean, that website where you can log in and see your portfolio or the statement that comes each month, all of that costs money. Okay, so back to expense ratios. This is the fee you pay these managers. It is a flat percentage that represents an annual fee. So for example, if the expense ratio is 1% and you have $100,000 invested, the annual fee would be $1,000. If you had $1 million invested, the annual fee would be $10,000. You've learned about all kinds of fees and expenses you may pay as an investor, but there's still one more. And this is a popular one. These are investment advisory fees. Again, this last type of fee is also pretty common. Financial planners and investment advisors may help you determine your risk tolerance, come up with an appropriate asset allocation based on your age and other factors, and may help you choose the investments for your portfolio initially, and may monitor those investments over time, buying and selling as needed. There will be a fee for this service. That's where the investment advisory fee comes in. It is often a percentage fee of the assets they manage for you. This is the Asset Under Management Fee, AUM. If they charge 1% and they manage $100,000 for you, you will pay them $1,000 a year. If you have $1 million they manage for you, they will charge $10,000 per year. So, as you can see, there can be more than one layer of fees. You may pay an investment advisor 1% a year to manage your money, and that investment advisor may suggest you purchase a mutual fund that has an expense ratio of 0.5%. In that case, you'd be paying 1% to your advisor and 0.5% to the mutual fund manager for a total of 1.5%. When you're looking at fees, make sure you look at all the fees you're paying. Total them up to see what you're really paying. So what should you remember from this lesson? As a rule of thumb, it's best if your investment advisory fee is 1% or less, and the total of your other fees are 1% also. You should have no problem having total expenses per year of 2% or less. If either the fees you're paying advisor or the fees you're paying the investments themselves combined total more than 2%, you should definitely dig deeper and find out why. And that 2% rule, that's really the maximum you should be paying. You should be able to bring that down to 1.5% or maybe even as low as 1%.